CIO at Quant Mutual Fund, joining in on the show right now to give us his insights. Sandeep, hi. Good to have you on the show once again. And looking at your green, I feel a little bit more cheerful, Sandeep. But given that all that the government is doing, that cheer is not reflecting at an index level. If I were to just look at what the Nifty has done, it's just been stuck in a range.
So these are like typical behavior signs when there's opportunity. People will be too much fearful because unwarranted pressure got built in last few months. Okay, and that's the reason even good news are not able to get digest or this any impact on the market. So I think the background is good, because now, see, I always said that Trump is a deal maker. He's not going to break a deal, but he has his own way of doing things. Now some of the people have written off him completely because ultimately we are doing business with each other. And businessmen always try to work it out despite whatever posturing you do. Now, given the background, the Indian macro is slightly improving with the GST and some of the tax initiatives government has taken. I think it will definitely boost the sentiment and overall volume. So I think the background is perfect. Where extraordinary short positions are there. People have virtually capitulated. Even the bull thought process is also getting capitulated. Forget the exact position. So I think this is the way I look at it, as a time to increase India exposure, maybe a few days here and there, doesn't matter. But in a larger perspective, India has underperforming the developed market. India has underperformed emerging market. I think now things are, background is there where one can look for upside. So I will look for a consolidation with positive bias rather than saying with a negative bias.
Absolutely, the bullish Sandeep Tandon always looking at it as a glass half full approach. But Sandeep, you've always said that every bull market has its own leadership, right? And I think this time the leadership was with the retail participant. They stood by with the markets. They were consistent with their SIP flows. Do you think the new retail participant of today's India is the smart money? And the smart money believes in consistently deploying at the markets and not waiting for that one opportune moment?
So if you look at this thesis has played out very well. I said that this time driven by retail, and retail has very large space. And if you really look at, despite last 1 year, some of the SI books are negative, market has not able to deliver returns, but it has not tested the patience of real retail investor. I'm not talking about the HNI or family office. For them, I always call this a business, is not the investment. For a real investor, they are still committed, and I think that's a cycle which I talked about. This has more legs, and since they have made so much money in 2021 to 20 to 24, they will not going to get scared with this sort of correction or sometime which is getting even extended. So I think the background is perfect. Retail participation has showcased its strength. You have seen the mutual fund SIP number, you have seen month-on-month number, which there is no signs of any concern which I have to talk about. Yes, sometimes you might see certain sector thematic funds have peaked out, so maybe money move out to large cap. And we have not seen any significant downtrend even in the mid and small scale space also. So I think the retail who has been on the driving seat has showcased his real intent. They are willing to participate in the mid and small also, even from the current level. I think this is a very constructive background for the market.
Sandeep, you've always been a pharma bull, and you've always maintained, even when Trump was threatening tariffs on pharma, that Indian generic players have nothing to worry about. Still standing by with that view, and are you still adding positions to pharma?
So our thesis has not changed. I'm saying sometimes best of the analysts also give up, but you look at what are the options Mr. Trump has. Given the strength which we have on one of the largest markets here in the generic market, there is no substitute for Indian generic company, and it's not like that you can buy a towel or a bike from somewhere else. Okay, when it comes to medicine is concerned, you need FDA approval, you need all sort of approvals should be in place, quality check, and that comfort they have with India. And if you look at any global supply chain, any radical changes which happen, it's a 6 months to 12-month process. Nobody just says overnight, I will change the vendor. Okay, all these MNC companies take their own sweet time. That's the reason I'm saying initially also, despite the worry which we have, people have built up inventory and they will find out a way to deal with each other because the mutual comfort which they have been there for over a period of many years, that does not change overnight with one statement, and people will find out the ways to work it out. And so is the thesis with pharma. Nothing has changed. If you really look at, despite so much noise, nothing has happened. It's still exempt sector, and I think it will remain exempt for a while. So unless they build up their capability, it doesn't look like even next 4 years they will not be able to build it. So I think that edge India has, and maybe good news is that every company whomever we spoke to, now they are saying they want to dilute US and they want to focus a lot on Europe and maybe other countries of the world rather than just looking. So maybe net US, their step, whatever noise they have created, they will actually be more impacted, at least the pharma sector is concerned, because India will look for new market and they will get it. We have not increased our exposure in pharma because whatever maximum we could build, we already have. So we are pretty satisfied whatever we have, and we are riding that move.
Okay. Sandeep, much like pharma, there was a fear or scare which still perhaps persists, although overnight now we've seen that there's been a little bit of a thawing of relationships between, Trump and Modi on Twitter itself. But the Hire Act 2025, wherein there is a proposal that there will be a 25% tax on companies hiring foreign workers. Now that stands to threaten IT services as a pack. For an under-owned sector like IT in India right now, what is the view there? Because I can't really draw up an apple-to-apple comparison between pharma and IT.
So the way I look at it is that, these are again noise and narrative which has been created. Obviously, everybody has opinions, so anybody can say anything in US, okay? But to convert into a law and take a drastic step looks unlikely. Like, we have been very bearish on IT for a while, and now if you look at last month's fact sheet and last 1 month, we have built some of the IT exposure because they reached that desired neglected space where people have given up, and the noise was so negative that people were not even willing to talk about the technology names, and this additional worry on the taxes will be applicable in the services. So that could be the peak of this crisis which we saw last week. We have been slightly constructive now. I'm not saying that we are going all out and building a very large exposure, because I think earnings cycle is yet to bottom out. My own estimate is that maybe by September quarter, earnings cycle should bottom out, and maybe December quarter you might see first uptick in the IT space also, and hopefully by the time our tariff related challenges should also settle down, so it can be a sentiment booster. So negative news will be completely discounted, and maybe looking for earning upgrade, under ownership is there, and if market moves up, I think this is one sector which has underperformed. So it has potential to outperform from the next 6 to 8 months perspective or 6 to 12 months perspective.
Sandeep, large cap IT or niche plays like a Persistent or a Tata Elxsi, etc.? Because in the previous cycle, it was the niche plays which held out a lot better.
So I think the way we look at, we have built exposure in the large cap IT because they are relatively more cheap. And most important thing in this challenging environment, I always say liquidity is more important than the returns. So mid cap IT maybe all looks very nice, but they are relatively illiquid as compared to the large cap name. And given the background, and I think purely from a liquidity perspective, valuation perspective, and safety perspective, I think Indian IT large cap looks better than the mid cap space in general. But obviously there will be stock specific opportunity in the mid and small also.
Sandeep, what's the best way to capture the GST fillip? And is it, as the market is telling us, via autos?
See, what market is liking is that the impact when you're talking about 20,000 on a bike or 80,000 on a car, obviously is a sizable number. But what we have to understand that you don't buy a car and bikes on daily basis. It's a once in a year exercise or once in a few years exercise you should do. But people are here ignoring the FMCG space where, let's say example, from 18%, many such companies will straight away now move to the 5%. Particularly, I'm talking about the food space. That's a very large discount which is there, which obviously going to impact the local brands in a big way, and people will move towards the branded products, and because of purely quality when they are getting at a better price. But I think what is a re-rating candidate from a longer term perspective. The P expansion can happen further from these levels. So it's not like this phenomena is only there for a few months or few quarters. I think from a longer term perspective, you have just 5% thing. I think the whole multiple will change for this space, which has been in a neglected space. People are not talking about this space. People are tired about this space. I think that is something which I'm more optimistic. Okay, auto obviously has done very well in last few months. Let's say a few months perspective. Last 2-3 months, auto is gradually inching up, and this is the big booster. But can it sustain as compared to other FMCG names? I'm saying overall consumption is good, but I think as FMCG also from a longer term perspective will be good. I'm definitely constructive on auto also. So I think I will not like to take just 1 quarter or 1 month phenomena. I think something has changed from longer term perspective. So it will impact the earnings potential in a big way, and it will obviously lead to a better P expansion, which has been compressed for a while.
Well, indeed. Hi, Sandeep. This is Shrishti also joining in. But to the point that you were making, that consumption will get a big fillip. Yes, there's a lot of excitement, sector-specific, FMCG, staples, discretionary and autos. But post the announcement, Sandeep, anything fresh that you have added within your portfolio?
No, we have not added because we are largely invested. So we are running a nearly 98% investment sort of thing, because in this market, if you don't build your position, does not make sense to hold very large cash. So we are anyway largely invested. So we have not added anything new in last few days or so, because we are largely deployed, and a few percentage cash is always going to be there.
Okay, and Sandeep, this is Snehi also joining in. I was just going through your fact sheet, and what I can see is you've increased exposure to silver. Now, while gold is also inching fresh highs every day, you also have silver that's now starting to find its momentum. Where do you think these precious metals are headed, and what is your take when it comes to precious metals? And if you could also share your view on our Nifty metal overall as well, if that is a play that you are attempting at the moment.
See, for last few months, when gold hit the nearly 3,500 mark and started correcting, we were very clear that gold has either make a trading top sort of thing, or maybe upside is getting capped. And if I look at purely from a silver being industrial use also, and the data points on silver were more constructive. So we actually sold off a complete position from gold, and we have to maintain minimum 10% in the multi-asset fund. So we started building up silver exposure, and maybe last month we have seen we were as high as 30% silver. So, and the trade played out quite well. The silver outperformed gold. So we are not negative on gold from a longer term perspective. But if I have to talk about purely from a very near term and medium term perspective, I think upside is getting capped. Too much hype is getting built. So that's the reason we played this thesis, and it worked in our favor.
Sandeep, a lot of new paper as well entering the market. Any space or pocket that's intriguing you, just sectorally?
Frankly speaking, we are very cautious on new paper, because what happened, every company or promoter expect extraordinary valuations, and whatever reason, if they are unable to perform, then people patience is not there. People just typically unwind their trade and move out. So even they have to book losses, people are doing that. So we are generally not very comfortable or very excited about this new paper is coming, because nothing is coming at cheap valuation. Everything is coming at extraordinary valuation, and a lot of stories are getting built. So we are very selective and I'm very choosy. I think this is one of the big risks which market has right now. As earnings season gets over, a lot of promoter-driven selling comes, private equity selling is also there. So we have to be very selective and sell these names, in the name of clean out trades. A lot of people are getting trapped. We are very, very skeptical about this whole space where extraordinary supply is coming, and that too in the illiquid stocks.
Sandeep, lastly, I also want to understand a little bit more about the new fund that you have launched right now, the specialized investment fund called your QSIF Equity Long Short Fund. Help us understand how this entire mechanism of the long and the short works at the same time, and how are you picking stocks under this new fund?
So this QSIF fund, which we are launching on 17 September, the long short name. Okay. Obviously, See, it's a unique product, and Sebi has taken initiative to introduce these long short thesis also. See, what is very important to understand is that a lot of either people are too excited about this product or they're too confused also. You don't know how to handle this. In the way we are explaining this product, we are not saying that you should look SIF only in isolation. If you are existing mutual fund investor, then you should try to add SIF type product in your portfolio. It gives you better diversification. It gives you bring down your overall volatility of your portfolio as a combination, and then you have additional source of alpha which you can generate to by going on the short side also. So if I have to look at some various scenario, like if you talk about a raging bull run, obviously mutual fund schemes will outperform the SIF, because SIF which we planning to run is more in a conservative manner. Globally, these products are also known as a market neutral product or low vols product or absolute return product, depending how like it. We think India, we want to run like as a low volatility product, so basically more conservative. So when I'm talking about my mutual fund schemes where my canvas is completely open, we have 100% flexibility. If I combine these slightly low risk product in our portfolio purely from the statistical perspective, then I think overall portfolio walls will comes down, beta value will come down, and it will give you a lot of peace in a difficult. Let's say if this product was available 1 year back when the market started correction, and this product would have outperformed the mutual fund scheme. So that I think what is very important in certain scenarios, SIPs will do very well, and certain scenarios mutual fund schemes will do very well, and that's the reason I think it should be a perfect blend. We are as aggressive view that over the next 5 years, you should have 50% exposure in mutual fund and 50% in SIF, and that will give you a superior risk-adjusted return, and you will be able to capitalize opportunity on both on the long side as well as on the short side if you combine it. That's the way we are trying to pitch this product, which is a far balanced approach rather than just looking in isolation.
Yeah, and makes sense as well. But Sandeep, so great having you on the show. Thanks as always for your time.
Yeah, thanks for inviting us.
Much for taking your time out and joining us here on ET Now. Tell us, how big a news is this for the industry, especially at a time when the industry was already reeling under the pressure of US tariffs. How is the industry viewing this development?
I think my smile on my face sums up a lot of things. Definitely over the last, let us say 3 months, we have not seen a smile on our face. But this European Union's the listing of all the establishments which have been long due for the past 6-7 years, which have come through in the last 1 week or so, is definitely a welcome change. I would place it on record our appreciation from the exporter side. The amount of work our Minister of Commerce has put in. Mr. Piyush Goyal has taken up this issue personally and made sure all the units are listed as soon as possible. And the entire Ministry of Commerce officials have worked overtime to make sure all the units are approved. So definitely this is a welcome change, and this will definitely help the industry to diversify markets from US into Europe, which is one of the biggest markets. Though it will not happen overnight, but over the next 6 to 9 months or a year, our volumes to Europe will go up. So this is definitely a welcome change, and we appreciate and we thank the Union government and our Prime Minister and the Ministry of Commerce for taking this at the right time. I think there is no better time than this, when this approvals would have come.
Understood. So since you're saying that volumes to EU and Europe are expected to inch higher, if you can put things into perspective and put it into numbers for us, how much do we export to Europe currently, and how much is it expected to inch higher by on account of this move?
See, our sales to Europe is, I think, slightly less than 20% of the total volume now. With the US taking more than 40%, Europe is slightly around 15 to 20%. So we expect at least another 10% jump in the 6 to 9 months period from now. That is really going to help the exporters and release the pressure from the US market.
And since the industry is already reeling under the pressure of tariffs from US, I believe US is not a market that the industry is eyeing at the moment, and the focus will also shift to EU. But apart from these two markets, which other markets does the industry cater to and is looking forward to increasing their share in those markets?
Of course, UK is one. Again, we'll have to appreciate the government for the FTA, which has just happened with UK. That is one market which could open up. The other market is Japan. We are aggressively pursuing to expand our Japanese market. China is there. And then Russia market is one good market which we have requested the Commerce Ministry officials to take it up and give us, because most of the units to Russia, most of the units are not approved to the Russian market. If that market also opens up, that will help us. And South Korea is one good market. Our government is, though we have FTA in place, there are few issues which need to be sorted out as far as the seafood sector in the FTA. If that is sorted out, I think the South Korean market also will open up for our exports.
Sir, since you're with us, I also wanted your thoughts on the benefit the industry will enjoy on account of lower GST on inputs. I believe input on several products, farm inputs, fish seeds, fish oil has also been lowered. Will the industry be passing on the impact totally to consumers, and how much will retail prices fall by on account of this GST reduction on inputs?
See, that's a fair point. But when it comes to the farm inputs, all the inputs will be directly beneficial to the farmer. That is good in a way. At least the farmer gets the benefit. His production cost would lower slightly. They could come down. So that will help the farmer. But when it comes to exporters, I don't think the inputs, the GST inputs will really affect the exporters. But the farmers, yes, we are happy for at least that helps the farm sector.
Understood. Sir, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the industry's viewpoint is when it comes to the latest development from the EU. Thanks so much for joining us today. To discuss this in greater detail, we are also now joined by Nitin Avasthi, analyst at Incred Research Services. Nitin, thanks so much for joining us here today on ET Now. And since we were just talking to the Seafood Exporters Association, you must have heard about how bullish he is when it comes to increasing exports to the European region. If you can tell us from a listed universe perspective, I understand we cannot talk stocks, but despite that, what is your sense when it comes to this news piece, and how much could exports to the European region increase by on account of this?
Firstly, there is no way to put what has come across. This is very unexpected, and the optimism that this brings with it is enormous. Why am I saying this? Let's look at the major consumers of shrimp. So you have US. We are the largest share there, and we are growing our share. We are growing in absolute volume. We are growing in absolute price there. You have China. Of course, we compete with Ecuador there. We are the second guy there. You have Japan. We are on the top there. And we were confined to this whole environment, and we have in a way saturated that market. Of course, then we can contend on how much the growth can be or not. We were completely barred out of the EU market. And this was a very long-term process, very painful process. Apart from just tariff barriers, non-tariff barriers were massive. One, of course, non-tariff barrier is the one you're discussing right now, that your plants will not be approved. And if plants are not approved, of course, you will not be able to export to that market. And we were completely pushed out of that market. Of course, the thought process at that point of time could have been that our products are subpar as a country. As of today, that is not the case. As of today, we are, because of the dynamics of the industry, out of the commodity segment very largely. We are growing and capturing a very big part of the value-added segment that is there. And that is the segment that is required in Europe.
Understood. So you completely agree with the point that value-added segment is going to increase their share. But Mr. Nitin, if you can also tell us, what is your stake when it comes to, you've always been bullish on the sector and now you have all the more reason to be bullish on the sector. But which will those triggers be that will drive the sector higher from here on? I understand the industry has already digested the impact of additional tariffs. In fact, we had the association telling us that exports to the American market has declined drastically over the last 1 month. So then which will those triggers be that will drive market or the industry higher from the current level?
Okay, now here this is an important point to understand. On a calendar year basis, if you exclude the last month, numbers of which are yet to come in. Exports to US are up 20%. So yes, there could be a null period of a month, but on an annual basis, we will most likely still end up higher when we talk about exports in volumes and in value to the US.
Understood. So that's the outlook when it comes to the industry. Nitin, thank you so much for taking your time out and joining us here on ET Now.